So the Fed has bought trillions in securities, about $2 trillion in U.S. Treasuries since March. Right now it's going at a pace of about 80 billion a month. It was several hundred billion a week to begin with. And it's also bought about 1 trillion in mortgages. So the balance sheet has shot up to about 7 trillion. So to put that in perspective, that 3 trillion of buying, the deficit right now is projected to be about 3.3 trillion. So the Fed is essentially buying 2 trillion of treasury issuances, which helps the government run a deficit. So the combination of this quantitative easing, these asset purchases and rate cuts has pushed down short rates. Fed funds is a short-term rate, and then the asset purchases help push down like 10-year treasuries and 30-year treasuries. It's a longer, has an effect on the long end of the curve. So the Fed announced on March 23rd that they're going to begin purchasing corporate bonds. And that's the exact date that the market bottoms. So the market took it as a turning credit, which helped spark the rally we've had since the bottom. And it's significant in that they haven't bought investment grade bonds directly before. They haven't bought high yield bonds directly before. And they're also buying ETFs, both investment grade and high yield, which are all beginning. So what it does is it helps credit rally. Effectively, the Fed is implicitly backstopping credit. So that led to a rally both in corporate credit like high yield and also into equities. Rates have been low internationally for a while, and they're much lower than in the US. Basically, when the Fed cut, they kind of closed the gap a little bit toward it, but rates in Europe and Japan are significantly below they are here. And what that does is create a low yield environment throughout the world. There's this tremendous search for yield. I mean, half the bonds globally yield less than 1% right now. There are negative rates in Japan, negative policy rates, and negative rates in Europe. All told, there's around 16 trillion in negative yielding debt. And if you look at Europe in particular, over half of the government bonds have negative yields. Over half of the corporate bonds have negative yields. And even companies who issue in euro and issue in that Europe market have negative yields. For example, Mexico has issued debt in the euro market, and that trades with a negative yield right now. So what does that mean? I don't think we get negative yields here. We get a question about that all the time. The Fed's been very explicit that they do not expect negative yields. They don't think it works, and it hurts financial companies. But it does pressure rates lower here and helps keep a lid on rates, because when rates are higher here, it attracts foreign buyers. You see a lot of European buyers, you see a lot of Asian buying. And it also, one of the reasons rates are low internationally is because, like the Fed with QE, the ECB, the European Central Bank, is also buying debt, both government bonds and corporate bonds. So between the two of them, there's this massive amount of liquidity globally that pushes down yields, and also all this money chasing assets. So it supports asset prices, risk assets like equities and fixed income credit, but also keeps the lid on yields. I think the Fed would potentially raise rates if the economy was stronger than expected. So you could paint a scenario where, particularly beginning next year sometime, once the pandemic starts to fade, there's a vaccine and there's a lot of pent up demand, and the economy is quite strong, and maybe inflation comes a lot earlier than they expect. Then the Fed might raise rates earlier than the 2024 timeframe. The other one is, like I said before, all this money helps prop up asset prices, and one thing that they don't want is an asset bubble. It would have to be pretty extreme, but they could potentially raise rates earlier to help tamp down asset bubble, like if equities got too rich or credit too rich. I don't think that's the preferred method, is through rates. They would rather do that through other means. They call it actually macroprudential means, in other words, through regulation, and try to control markets that way. But What they don't want is a big market bubble that's going to pop and then create a recession. The Fed this fall adopted a pretty significant shift compared to how they ran things in the past. And essentially what they said they're going to do is hold down rates for a very long time in order to try to get inflation up. And they're actually willing to let inflation run a little hot to their target, which is 2%. So maybe it runs 2.5%, maybe it runs up to 3%, but more likely around 2%. And what they want to happen is for inflation over time to average 2%. So the policy in Fed speak is, flexible average inflation targeting. And the problem is that the Fed adopted a 2% target for inflation. They use core PCE as the measure. They adopted that in 2012. And since then, inflation has only been above that target about 10% of the time. So they've failed to hit their goal and target. So the hope is by letting inflation run hot, that over time, that policy will become more credible, and that'll jumpstart inflation. So it's a big shift. And what they used to do before, traditionally, was preemptively raise rates. So if you go back in time, the economy, as it heated up, it might start up inflation and unemployment would get lower. And once it started approaching a level that the Fed thought was kind of the natural rate of unemployment, where the economy could keep going, they would start raising rates to make sure the economy didn't heat up. The problem with that is sometimes, higher rates contributed to tighter monetary policy. It helped to trigger a recession then. So they were contributing to the problem. There's an old saying that economic expansions don't die of old age, the Fed murders them. So the Fed's going to try not to murder the economic expansions by raising rates prematurely anymore. And there was a quip once by a former Fed governor that saw the Fed's role essentially as taking away the punch bowl just as the party gets started. Traditionally, there's been a relationship between unemployment and inflation. The economists call this the Phillips curve, but as unemployment got lower and lower, it would eventually hit a level where maybe wages started increasing and that would spark inflation. That hasn't happened. That relationship has pretty much, at least recently, stopped altogether. So they're willing to let inflation go lower than they would have before. I mean, you can look at, for example, 2018 is one of the times the Fed raised rates. Inflation was getting very low. They had started hiking rates after the global financial crisis. They hit 2.5%. The market didn't want them to raise any rates. It was very concerned. The last rate rise was in December 2008. The market kind of rioted and the Fed backed off. And we never realized significantly higher inflation out of lower unemployment. The question, natural question is, why do they want higher inflation? The main thing, as I mentioned before, is to avoid deflation. Deflation can be very pernicious. It is bad economically, because when you think the prices are going to be lower in the future, why spend now? So it can affect spending. The other thing that it's very bad on is debtors. So if you owe a bunch of debt, say you take out a big mortgage and there's deflation, your wages are going to go down, but the amount of debt you owe doesn't. And if you think about what is one of the largest or the largest debtor in the world is U.S. government right now. So a deflationary environment would be very detrimental to paying back that debt. So inflation is desired, moderate inflation, but that is a good thing economically. They haven't succeeded in the past. They're not, at this point, using radically different tools than they have in the past. Rates near zero and quantitative easing, the level of quantitative easing is greater. But the market is, quite skeptical. I mean, you can see break-evens, immediately after they announce this policy, and break-evens are a measure of inflation. You get them off tips. Those had been rising, they fell. So the market is quite skeptical. Well, the first thing they would do is, hold rates lower for longer. Maybe they would increase QE. They most likely would do shift purchases out to the longer part of the curve. Right now, it's spread somewhat out, between short maturity debt, intermediate. They'd probably focus on the long end of the curve and try to depress rates there, which might help spark inflation. And they could also do something that's called yield curve control, which Japan has adopted, and that's where they target a specific rate, probably the 10-year maturity. So maybe they say, we want the 10-year maturity at 50 basis points, and we're going to do what we can to keep it there. So initially that takes a lot of buying of treasuries, a lot of buying of debt to keep it at 50 basis points. But once you establish credibility, you don't really need to buy anything. So those are some of the tools that they have. We expect rates to be low for a long time. The base case is that they'll stay low through 2023, maybe into 2024 or longer. They're going to have problems sparking inflation, almost certainly. There's no reason to believe that things will change, radically from the past. But we do expect rates to be low, but I think the risks are very asymmetric right now. In other words, they're low, so how much lower can rates go? Not much. Don't expect the Fed to take rates to the negative level. The market might take rates negative in the short end of the curve. You actually saw that briefly for a day or two in March of 2020. But they could go a lot higher if for some reason, inflation rose quickly or the economy heated up. So the risks are somewhat asymmetric. And I think that highlights another issue right now, is that there's a lot of what we would call duration risk in the market. In other words, a lot of interest rate risk. Part of that is because at lower yields, bonds are more sensitive to movements in interest rates. And also there's been a lot of issuance both of treasuries and of corporate bonds. And these tend to have very low coupons because rates are low. And a lot of companies have issued out the treasury curve, in other words, like 30-year maturities, because the cost of going to 30 years isn't that much. The treasury curve is still relatively flat, and they're trying to lock up liquidity. So the point is, all this debt is very sensitive to moves in interest rate moves. So if rates were to go higher, you would have negative returns and longer maturity. So I think the point is that it pays to stay relatively short in duration. We prefer to stay in less interest rate sensitive asset classes, and you're not paid also to take long maturity risk. I think rates will still, work as a hedge overall, but a lot less effectively as they have in the past. So in order to get yield, you'll have to take credit risk, or, get into areas like investment grade corporate credits. Although yield there is relatively low, you get a lot more yield in, high yield or leveraged loans. Emerging market debt also has yield. And that's where you're going to find more meaningful yield in today's world of a low yield environment.